right. So last week, we had a good interactive session on minimum viable product and idea creation. We've had all that. Now it gets to the numbers, right? The business model, the cost structure, the things that you need for the financial types and others to back an idea. And I couldn't think of anybody better to do this session than someone who schooled me, right? Bryant, who is not only a educated investment banker, numbers guy, but also a venture capitalist. So what I want to cover in this is kind of, okay, you've got a minimum viable product, you've sold it for some amount of money, you've got enough raw data to put together a set of numbers. How do you do it? Where do you start? And how do you do it in a way that is detailed enough to look valid, but not so in the weeds that a venture capitalist or an angel investor or someone gets lost? So with that, I will turn it over to Alan. And again, Alan, start us up from the very beginning, right? We got an idea, we identified a problem, maybe we've sold some initial product, not necessarily for the retail price, but we've got some people to pay things. What do we do now to put this in a quantitative form that people will understand?
Yeah, absolutely. So I'll get to that in a second. I think it's just helpful quickly to run through just a little bit of my background, and I think it's helpful just to understand how I approach modeling and kind of just the different angles you can approach it. And then I will not ignore your question, John.
Go ahead, it's all yours.
Awesome. So my background started actually with investment banking. So working with very large public companies, doing a lot of M&A type work, debt financing. So really, say about as late stage modeling as you can get. And then more recently, I was a private equity investor. So looking at models through the lens of you're making an acquisition or you're putting debt on a business. What does that look like in the next 3 to 5 years? Do you have cash flow enough to pay down the debt, to pay down the interest, and playing with some key variables being how much you're paying for a business, how much debt and what terms you're putting on the business, and what the ramifications are there. And as John mentioned, now I am an early stage venture capital investor. So it's completely different modeling when you're thinking about it from this lens. And really the goal of a model that you're pulling together at an early stage company is really as much to show externally to investors as it is to have as an internal tool. And what I mean by that is think about the budgeting, but also you have key levers and variables with any business. So John mentioned, you have a product that you're looking to price and sell. You want to understand, what the correct price point is, who you want to be selling to. There's going to be sales cycle ramifications, how long it's going to take to get the sale done, how long or how many salespeople, et cetera, you're going to need, what the margins are, all these types of variables that ultimately are somewhat in your control, and you just want to be cognizant of all of those. So I guess from my standpoint, I think I'll lead by saying all models are never right. They're never 100% right. And I think John knows this just as well as I. you really just want to see it as a tool and be able to play with these variables, play with the levers that you have control of, and understand really where you should be focusing your time. A couple other quick thoughts, and then I would love to just keep this as interactive as possible. So actually, I don't have any materials prepared. I do have a model that I can walk you guys through, but I think what would be, and I'm happy to share that model with everyone after this, whether it be Slack channel or via email. But I think what would actually be most interesting is if folks do have businesses they're working on, if anyone wants to volunteer in a bit, we can just talk through, what assumptions and what drivers and what a model for a specific business that you guys are working on would look like. And then a couple high level thoughts before we do that. So as a venture capital investor, a few things that we look for in models is really that people are being thoughtful about the assumptions, the drivers. So ultimately, I'm sure everyone on this call has heard the idea of you want to sell the dream that your startup can ultimately be $1 billion business. That's great. But at the end of the day, what you show needs to be very defensible. And we can talk through a little bit about how to defend that. But looking at, if there are similar products in the market, what those are selling for, what the sales cycle, when I say sales cycle, how long it takes to make those sales. When you hire someone, what comparable salaries are in the industry, what are the general outputs of those folks, things like that, where you just really want to be thoughtful in everything you put forward, because the quickest way for us to discount or lose interest in the business is seeing some assumptions or drivers that just don't make any sense, and that to us just shows that there's not a lot of thought going into it, or just a skewed view of what is possible. So I think that's honestly the high level. But if we want, happy to answer specific questions, or John, if you wanted me to go through that one example, or I can walk through kind of a template model that I've pulled together for companies that we've invested in. We typically invest in kind of the pre-seed seed stage.
Sure. We have one question, and then I think we walk through the template. And then what I would really like is some volunteers here, because if they're like me, they're always working and reworking a model, to give you questions directly, because I'm sure there's lots of them on okay, how do I put this out? I really don't know how to calculate X or Y, but I need to present something. How do I do it? So there's a question in the chat. Can you explain what you mean by drivers? And then go through the template, and then we'll call on people, hopefully get some volunteers, and just say what the stumbling blocks are to building the model template that Alan presents.
Yeah, absolutely. So great question. And what I mean by drivers is essentially assumptions that ultimately change the model. So the easiest or the most notable ones are how much you're selling your product for, how much you think volume wise you can sell. If you're making hires, when are you gonna make that hire? What are they gonna bring to the table? How much you're gonna pay them? All of these essentially decisions that will that will ultimately change the trajectory of the model and build a model. So it's really just another way of saying assumptions.
Okay, then yeah, I think maybe go through the template, and then I'm gonna ask for volunteers, or just everyone come in and give their questions and give some inputs that they have in the model that they have, and maybe some stumbling blocks on making the assumptions, and we'll make it very, very interactive.
Perfect. So I'm just going to share my screen.
You might have to give them permission.
Yeah.
Okay.
Okay. So again, I'll share a version of this with everyone, but just again to walk through at a high level. So this tab right here is really what I was describing when I said drivers. So that can really mean, and this will change business to business, but the key ones are how much you're selling it for, what the margins are, and that will typically, if you're selling this business, for example, we're selling PPE and accessories, clothing to retailers. So you have typically you would have a customer that maybe you're selling a lot of product to at a certain margin. Maybe it's fast sales, and that is going to have a different impact on the model than a larger sale that maybe is less frequent and higher margin versus. So I've kind of redacted the names here, but you can get the idea. You want to be as granular as possible in terms of customer types, or if you're selling different products, you want to break that out. But I would say,
Alan, can we blow that out a little bit, make it a little bit larger?
Yeah.
There you go. Good. Okay.
Right. So what this is saying is, if you're selling 5 contracts or products at a price of 5,000 at a 35% margin, and the idea is everything here, if you change this, will flow through the model. I can show you guys this in a second. But so you have, I just arrowed where this goes to. So this all flows through the model, and the idea is you can change these 9 cells, and then your revenue model will change to reflect these changes. Net working capital, I don't want to spend a ton of time on, because I assume a lot of your businesses are software or technology focused. So I'm just going to hide this for now. If we do talk about a business that is consumer products or similar, we can definitely talk about that. And then the other kind of driver that you're going to see a lot of is you have salaries, right? So what are you paying your people? If you're going to make new hires, when are they starting? And again, the idea here is all of this is very dynamic. So if I want to make a hire on, and this is outdated now, but May of this year, now this will flow to the model, and now we are making this hire is going to come on May of this year now, right? And then further to this, what you want to be thinking about is when you bring people on. So maybe you bring on a CFO, for example, they're not necessarily going to have any direct revenue coming in from their hire. But if you bring a salesperson in, there should be some thought around how much revenue are they going to bring in. If you bring in, other folks that are directly correlated or directly responsible for some part of advertising, branding, that type of thing. There should be some reflection of what that will change from a revenue standpoint. So maybe if you bring in an advertiser, if you focus on your branding, maybe you can charge a slightly higher price. Or if you bring in 5 new salespeople, you expect them to bring 2 new customers each at XYZ assumption. So just having it being very formulaic and being driven by kind of one area with all these assumptions, I think is just a really clean way to do it and a really easy way to think about this. Any quick questions on this before I just quickly highlight the other tabs?
Well, we've got one obvious one. Can we have access to this startup model template?
Of course. Yep. So I will. I'll send it. John, I'll connect with you after and figure out what the best way is. Maybe it's Slack or the email, but we can. I'll definitely send this to everyone.
Okay. Another one is, this is a product business. Would we use the same, or do you have a different model for a service-based business?
So I can find one for a service-based business. But really the key changes would be there's not going to be any networking capital, right? Or there's not going to be any inventory rather. And you can kind of change the price and volume to be more of a how many contracts you have from a licensing standpoint. So you can really make edits to this to get there, but I can look for one that's more software focused.
Got it. Same thing for a consultant-based business.
Mm-hmm.
This is Bruce. Hi, thanks for this. It looks great and useful. You mentioned there was maybe more you talk about for a consumer-based product type business. Is there any, what differences are there? Obviously, quantities are radically different, and you're looking at probably, hopefully steadier sales, or not just individually.
Yeah. Sorry, didn't mean to cut you off.
No, go right ahead. So I don't know what you'd add to it for a consumer product sort of business.
Yeah, good question. So a lot of times, and especially when you're starting off, you can have, if you have 20 customers, you can literally, you can have these be specific customers. So it could be Target, Walmart, Kroger's, and then how I would think about it is you're selling a certain amount to them on an annual basis or a monthly basis. And then the goal would be to increase that over time and add new customers. So the way I'd be thinking about it is what are the drivers to upsell to your current customers, and basically what percentage can you get to bringing on new salespeople, bringing out new products to your current customer base, and then how are you going to get additional customers? So additional customers may be building out the sales team, maybe adding products that other customers would want. But those are kind of the key thoughts I would have for that.
That's
Excellent.
great, thanks.
Andy has a good question because it came to my mind as well. When you're looking at this, how do you evaluate it? Or ask it a different way, what do you zero in on to see potential flaws or stuff that you like, right? When you're looking at a model like this?
Yeah, it's a really good question. So I mean, there are just obvious ones where you think about if you're selling a snack bar, how big is the total snack bar market? And if you're in year 8, you're assuming you're going to be twice as large as the entirety of the snack bar market. That's a red flag, right? So you think about it in terms of the entirety of the market. You think about it in terms of if you're selling to Target, what is their budget for certain products and services? And then, thinking about, I think that the biggest one is margin. So being really thoughtful in how much staff you're going to need to get to certain points. So look, the trade-off is always lower margin for to build a business, to add the operating costs that you need to focus on growth. So just making sure that hires are being made that are in line with where the business is, and that your assumptions are reasonable in terms of in reality, how many people are buying this product. If you're selling to businesses, how much are they spending on certain areas? If retail generally has been struggling, right? So if you assume you're going to grow retail 50% a year for 10 years, that might be tough, right? So just understanding, making sure everything is in line from a what is happening in reality, and that it checks out from that standpoint, I'd say is where we most commonly see mistakes.
Great. So this is a question I know that you've worked on. Can you adapt this model for a nonprofit organization? In doing that, how would you do that? What do you charge?
Yeah, good question. So, I mean, at the end of the day, a nonprofit model is not going to be a whole lot different in theory than a for-profit model. The key difference is going to be, obviously, your salaries are going to be different. Maybe you have a lot more part-time people, and then ultimately you are not going to have profit that's being distributed or cash flowing. So it all goes back into the business. But I'd say and something that we haven't talked about here is, and we will shortly, is all of this is going to feed into, so you have a cash balance. So maybe you raise $1 million, and that's going to get you to grow for the next 18 months, right? So you're going to be cash flow negative for 18 months, but during that time, you're going to grow to a point where then you can raise additional capital and then continue growing and then ultimately get to a point where you are profitable. For a nonprofit, it's really going to be very similar. You're going to raise funding. Maybe it's more continuous stream of funding with donors annually, monthly, etc. But ultimately, it's going to be the same core model, right? So maybe you're not selling a product. Maybe you are. It's more of a cost allocation. Nicole, what I mean, just to dive in a little bit deeper, what are you thinking of a specific nonprofit?
Can you hear me?
Yep.
What I'm doing is I'm finding housing for women who were recently released from prison. So what we're doing is we're getting permanent housing so that they can regain custody of their children.
Got it. That's great. Hats off to you for doing that. It's really fantastic work. So, I mean, in that case, would you be essentially funding the initial down payment? Would you be funding the rent? How are you guys thinking about that?
Well, what I want to do is to use the funding to actually buy the housing. So
Mhm.
I want to actually get the money to buy the housing and rehab it so that when they get out, they don't have to deal with biased landlords. We already own the housing, so they have a place to live when they get out, and we just serve as the landlords, and we just take, the rent money, and we just keep the money.
Yep. So I think I lost you at the end there, but I understand generally what you're trying to do. So in this case, you would basically be raising some money initially. Say you raised $1 million, and then you would be allocating those dollars to buying these houses. So maybe you're paying, and we don't need to get fully in the weeds, but maybe you're paying $50,000 down payment, having financing, and then you would think about what other costs you want to kind of cover for these mothers. But really, for that scenario, you're not obviously selling anything. It's really just you're raising money and then you're allocating that money. You're basically seeing how far you can stretch that. So the key there would be how much cost is associated with each house. So it's that initial down payment, maybe some ongoing costs if it's helping with taxes, etc., property taxes, or some necessities. But it's really understanding what is the all-in cost for that house, and what your goal is for how many houses you want to do, and then understanding how much money you need to raise for that.
Okay.
Does that make sense?
Yes.
Yeah.
Thank
So
you.
and we can talk offline, but it would really be, so the key there is understanding the all-in costs for one house. And then you can assume it'll be similar. And then just understanding how many houses you want to do and how much money that will need in terms of raising.
Okay, thank you.
Alan, you're active in the nonprofit sector as well. How would the model change at all to attract nonprofit donations? And the flip question is, what do you look for? I mean, I understand sort of what you look for in a for-profit funding venture, but what would you look for extra in a nonprofit, looking for donation money as opposed to investment money?
Yeah, it's a great question. So, I mean, the kind of the key difference is you're playing into people's passions, right? So in Nicole's example, you know, you're looking for people who they're obviously not trying to make money on this, but they are passionate about this particular issue, and you know, they just want to see that this money is being allocated in the most effective manner possible. So nonprofits in particular get a lot of honestly justified bad publicity for not being particularly effective in how they're allocating costs and where money is going. And a lot of times not a ton of money is going to the actual cause. So I think that the key would be showing that, look, there's $100 donated, 95 of that goes to helping this cause that you're passionate about. And then the X factor is obviously finding people who are passionate about this. And then another consideration would be certainly a lot of nonprofits have tax ramifications. So and John and I are actually working on something that is classified as a 501c3. So if someone were to donate that would be a tax write-off. So just communicating appropriately and accurately what the ramifications and benefits are for someone to invest. Yeah, did that answer that properly?
I have a question.
Yep, question here.
So what are some important things to keep in mind if your business is primarily service, but also some product base, like a mixture of the two? Like in education, for example, like you're giving the service of certain lessons, but you need like books and materials as products to conduct the lessons. So what are some things to do?
Yeah, for sure. So, I mean, at a high level, products are going to be lower margin than services. So you think about a product, there's always going to be the variable costs to build the product. And typically you can get, I mean, it varies, but maybe you're going to get 30 to 40% gross profit on what you're selling. And there's little economies of scale, meaning if you're going to build 50 products, it's going to be a similar price to building 100 products. Maybe you can save a little bit on some of the direct variable costs, but you're relatively stuck at that margin. So generally speaking, it's very difficult to scale a product, whereas a service, and if it's a software, the variable cost there is incredibly low. So it's really advantageous to sell as much of the service as possible. So maybe how you're thinking about it is you have to sell the product in order to then sell the service, is what it sounds like. So it's almost like the product is not the moneymaker. The product allows the service to be sold, and this service is the licensing agreement or recurring revenue from that is really where you can get the higher margins, get the economies of scale. For example, if I'm understanding correctly, maybe you're selling a software, an education software to schools. So the difference between the cost difference to you between selling to 1 school or 10 schools, maybe nothing, or maybe very, very small, but suddenly you're making 10 times the amount of money, right? So thinking about it that way, the service end of it is going to be likely a lot more attractive. And I think you'd want to ensure that you're gearing the business towards maximizing whatever is the most attractive segment of the business. And unless there's something crazy going on there, it's going to be the service piece.
Cool, thank you.
Of course. Just quickly, so and we'll continue with questions as well. But just running through the rest of this model. So here is kind of the overall model, right? So you have your revenue build, which all is driven by that other page. Your cost build. So this is, we were looking at, this comes from here, right? And sorry. So these are all from that first page. This line is all going to be from that first page, right? It just multiplied. And then these operating expenses again are going to be, so this is by month. So you're gonna have those annual salaries that we saw. Those annual salaries that you saw are going to show up here divided by 12. And then when you're making the hires will show up as well, right? So if we change this hire date, I showed you guys, then that would change here. And all of this, you have your hires, your sales commission, your other costs. I would just be thoughtful about, so you have your employee costs, and then you're gonna have just any costs, any other costs that you can think of, right? If you have people traveling to meetings, you're gonna have that cost. You're shipping a product, you'll have costs associated with that. You're paying for an office, you're paying for phone, internet. If you're training employees, if you have software, all of these things are going to be fixed and variable costs, but you obviously want to make sure you're accounting for those as well. And then this ultimately, so all of these come down to your, this is essentially your income statement, coming down to your net income and cash. So in this scenario, or in this model, this company raised $5 million, or sorry, they raised $1.2 million. So every month you can see this month they lost about $20,000. So their net cash is going to be going down, going down, going down, going down. And then they have a larger raise. And then it's just a long cycle. And then something that's helpful for investors is, so this is obviously really tough to look at. It's just a ton. It's monthly for a few years. So what I always like to do is have just a quick summary tab, right? So your revenue, cost, gross profit, your operating expenses, so the hires you make, and then your non-operating expenses in just a very easily reviewed format. And what this does also is it's helpful for you to look at internally, because you can see, all right, quarter over quarter, from first quarter 2021 to first quarter 2022, we're assuming we're going to grow about 3 times, right? Does that make sense? And you can ask that question for all of these, and it's just easier to kind of check your work and make sure everything makes sense. Same thing here on a monthly basis. We don't need to spend a whole lot of time there. And then cash flow, which I don't think we need to spend a ton of time on. But again, I will share this with everyone. And yeah, seeing some questions in the chat.
Yeah, investor entrepreneur collaboration. Question is, what are some investor red flags for who we might not want to take money from? How do we vet the investor? Very interesting question.
Yeah, let me read that one more time. Investor plus entrepreneur is collaboration. So my question is, what are some investor red flags for who we might not want to take money from? How do we, that's a great question. And it honestly, it happens more often than you think that the trap as an entrepreneur is looking to get money as quickly as possible. Fundraising is a pain. We all know it's a pain. And it is really important to understand how investors work with companies. So I mean, there's a few ways to do it. Definitely, you'll be having multiple conversations with potential investors. So making sure they're thinking about the business in the same way as you is really important. So you don't want to be in a situation where 2 years from now, the investor has an idea of where they want to take the business, and that's different from yours, because technically they're part of the decision-making process as well. They might be on the board. They have some sway there. So you really want to make sure you're aligned. And you can just point blank ask, right? Where do you see this business going in 3 years? Where do you see this business going in 5 years? And really ensuring that they're thoughtful about it and they're thinking about it the same way as you. I think the biggest and most helpful way that I've seen is talk to other founders that have been invested in by this investor, right? So as a venture capital firm, whenever we're about to make an investment, we say, please talk to some of our portfolio company founders, understand how we work with our founders, and that's incredibly helpful, because they can see, are they hands-on? Do they try to help out? Are they demanding? Because the worst thing you want is to have an investor that asks for things for their own purposes, right? Or just fundamentally thinks about the business differently than you, because it can be a real issue. So you don't want an investor that will on a weekly basis say, hey, send me over some financials, right? They need to understand that you're in charge, you're running the business. They're there to provide financial support and some operational guidance and other support as needed. But ultimately, it's your show. I'd say the easiest way is to talk to other investors that they've invested, other founders that they've invested in.
Question again, we're going to get this spreadsheet model circulated, right? This is a, I mean, this is a good P&L model projection. How important are the other statements, projections on balance sheet and projections on cash flow?
Yeah, so they are, it depends on what, so cash flow is definitely important. And we have that here. I didn't want to spend a ton of time on it because this is for a consumer product. So you're going to have inventory and other line items that you wouldn't necessarily have. But cash flow is definitely important. And it's really going to be similar to your income statement, with the exception of if you're selling a service, maybe companies are paying you once a month, right? And the cash will come in then. So it's really about timing of when you receive payments and when you pay employees, et cetera. But the cash flow is definitely important, if nothing else, to know that you're not going to run out of cash, and understanding when you need to raise again. Balance sheet is important, particularly inventory is very important for a consumer products or any types of product or physical asset that you're selling. But it's less important for software and licensing businesses. So candidly, a lot of times when you look at software businesses, there just isn't a balance sheet. And it's because, you know, everything is really captured in the cash flow and the income statement.
Yeah, actually, I had a question going back to talking about investors. Like, in what ways can an investor kind of control and push around the company if it only has a minority share of the company? Because it seems like until you get to that 51%, the owner can still kind of do whatever they want. But I mean, in what ways would an investor have sway with like 30% of the company?
Yeah, and look, it's a good point. That 51% is definitely a threshold that is very important. I'd say even 30% is very, very high. When we invest in companies, we typically have anywhere from 3 to 10% ownership. And that's typical of venture capital firms. But really when it becomes a murky situation is really if an investor has a board seat. And that just gets into other dynamics where now they have the ear of the rest of the board, other investors, and they can quickly become a majority if they kind of team up with other folks. But even simple things like it depends on the company, but there are certain events that require all board of directors sign off. And if you have one person that doesn't agree with it, suddenly there's an issue when there shouldn't be an issue.
Those events, I mean, are those events built in like with an initial contract when you take the investment money, or are those events kind of universal?
Can you repeat that one more time?
You said there's certain events that every board member has to sign off on. Are those events like structured into the original contract when you take the money, or are those events something that's kind of universal to like US corporate law?
Yeah, it'll be in the document. So you'll have a board of directors essentially operating agreement that dictates, you know, what maybe you need a majority for certain things. If you're gonna take out the CEO, maybe you need 100% board approval, stuff like that. But I think that the real concern is outside of, it's going to be rare that an investor, unless it's a private equity investor in which you're in a different boat, it's going to be rare that they're going to get anywhere near true majority ownership. But it's really the being in the room for the decisions and having a differing opinion that you can start swaying other people. And if you're disagreeing on items that are fundamental to the future of the business, it suddenly complicates things quite a bit. So yeah, it's less so to getting to that 51% versus, you know, you want to have a constructive conversation. And when suddenly, you know, everyone is in defensive mode, it just completely changes the conversation, how people are helping each other, what is willing to be said. It just really changes the dynamic of the company.
And hold that thought to some degree, because next week we're covering legal structure, and ask that same question, because there is, yeah, it depends on the documents, but legally, they can force a 2/3 or a 90% decision making, even with the minority shareholder, you know, position. And it goes back to Alan's point that, look, make sure you're on the same page to start with, and then everything kind of falls smoothly. But if there is some sort of conflict for the vision of the business, you know, don't underrate the fact that even if they have a small minority share, legally they can construct something where, particularly with a board seat, they have an overbearing power relative to the smaller equity share that they have. Right?
And if you have an LLC and you take on investment money, do you still have to create a board, or can it?
Well, you have your partners and managers. Managers running the business, and you know, participant holders technically are out there, but again, there can be legal constructs that will over-represent the amount of participation or equity that investor has, if they want to put that in place.
Yeah, I think you always have a board, though. When it's LLC, it's like named different. It's like members or something like that.
Yeah.
But it's, when you form the company, you have to make an operating agreement, which is the way the company operates. And anytime you get more investment, odds are you're rewriting that operating agreement to one. You have to, because the new ownership, so it has to fit that in there. And of course, the investor may want certain provisions in an operating agreement, which there probably are things like, to take on more investment, you might need a unanimous agreement, some things like that. Other things are not usually 100%, but
it falls more into the legal end, that they can construct a lot to over-represent relative to the amount of equity that they have to, you know, in operation of the business, right?
Okay.
But that's more legal than it is in financial modeling, but it just, it is there, but kind of shelve that question, because it's a great question for next week. Right?
Yeah, very good question.
You see this question up here? What do founders who build the right financial foundation have in common?
What do founders who build the right financial foundation have in common? It's a great question. I think it is. I mean, if I had to sum it into a couple words, it would be being incredibly thoughtful and doing your homework. So there's a lot of potential mishaps that you can avoid if you just really understand what similar companies look like, why they do what they do, why the industry operates as it does, and just really doing your homework into understanding why things are happening, for what reasons, and then just asking the right questions. But I mean, some of the best founders that I've seen are, zero ego. They come to our conversations and they're asking questions, right? They're not defensive, and they really want to get to answers that will help the business, not answers that they think are right or should be right. So I think it's just being incredibly thoughtful, being curious, and trying to get to the right answer, not answers that are easy or you think should be right.
Excellent. So I don't want to skip over this question because I think it's a good one. It takes a significant understanding of finances to upkeep the document. Beyond the session we have right now, what other resources would you point someone to kind of get the backing to be able to update this document? Newbie to finances have tried to generate this document multiple times, but seem to get lost in the detail. Chris, that is so, I mean, we all have that problem, right? So Alan, after this seminar, outside of knocking at your door, where would you point someone to at least get the basics so that they can put a spreadsheet like this? They don't get lost in a spreadsheet like this. This is a great template. I mean, I can't wait to distribute it. But where would someone go to maybe answer some questions after this session?
For sure. So before I do that, so I don't know if this is going to fully show what I'm trying to do. I don't think it will. To answer your question, the idea of this is you are literally not changing anything in the model except what is in here, right? So everything in the model is driven off of this. So the idea is the model is already built. You have a few questions or assumptions that you change, and that will flow through the model. I hear you on if it's not something you're familiar with or comfortable with, if you change things, you don't know exactly where they're flowing, etc. What I would say is you can, I would honestly, and this sounds terrible, I would go on Google and just look for financial modeling resources. And like I know when I was applying for investment banking internships, there were pretty good resources in terms of walking through an income statement, walking through a balance sheet, walking through a cash flow statement. I think just getting those basics will be really helpful in understanding this. And then I can try to make honestly a simpler version of this. But what I would try to do is, and you can see my screen right now, if you do, and this might be a little bit too technical, but Alt-M-D, and I'll type it in here. Alt-M-D traces where cells go, and you can literally say, all right, this goes here, this goes here, and you can essentially walk through the model this way. Or if you go, I think it's worth just kind of looking through, and I'll make sure all of these tabs are, or the cells are linked up properly. But you can honestly spend an hour here. It looks daunting, but you can within an hour go through every cell and see where things are coming from, where they're flowing. And I think it will surprise you with how manageable it actually is. But I think in terms of getting the basics down, there's some really good, like Training the Street has some stuff online, just to get like an understanding of the basics of the three statements, and an understanding that will help you use this. Nice. Got you, Chris.
Perfect. I don't want to lose any question here. My skill at the manipulating this computer is not that great. Hold on here. Do you have a spreadsheet similar or that can be adapted from within this model that allows for joint venture revenue share partnering agreements or multiple JV partnering relationship? Relationship modeling both cost and how profits can be split. That's an interesting question.
Can you say, okay, I see. Do you have a spreadsheet similar that can be adapted from within this model that allows for joint venture revenue share partnering agreements, multiple partnering arrangements, costs, no profits can be split? Yeah, so it sounds like a complicated thing to model, but it's really super simple. So what you could do, and feel free to reach out to me separately, but it would basically be, you could add something here where it's JV percent, and maybe you have 50% of this, 50% of this. And then it would literally just flow in as half of the line item into the model. I think and let me read this question one more time. Yeah, I mean, it would literally just be understanding what the total amount is and then dividing it by ownership. And then you would have business specific costs. So you're still going to have your CEO, C-suite, maybe salespeople, etc. But it's literally just going to be adding one line item that factors in how much revenue or costs is being allocated to your business. But a lot of this stuff will be the same. Does that make sense? Rick? Awesome.
I mean, this template really is looking like it's very useful. You can adapt it to almost anything, and it isn't nearly as complicated as it looks. With that being said, let's use our last half hour to drill down specifically to as many specific questions to your particular businesses that you might have for Alan on how to adapt this.
I have one question that's, well, it's related, but not really specifically to the spreadsheet. Is at what point do you hire an accountant and bookkeeper and things like that? Is there I presume you should have, when you go to pitch, you should have some kind of accounting service already in line. I don't know.
When you say accounting service, are you saying for the actual model or like reporting?
for your company and for, for operating.
Yeah, so I mean, there's a bunch of different ways you could do it. I mean, a lot of our companies will use I'm blanking on the name right now. I can look it up, but basically like an outsourced software. And then you can just download like monthly income statements or monthly monthly sales by every item. And then once you have that data, it's pretty easy to work with. You can, sum it all up, and then maybe you'd have like a tab in the back that's, backup. And then you would just paste in the raw data here, and that could link into the actual model. But really anything that you use for the accounting of the actual business, so whether that's an accountant, whether that's a software, you should be able to take whatever they're using and leverage that as at least the historicals, and at least understand what line items to include. But I don't think you necessarily need someone like that to create a model. And there's, yeah.
Sorry. I was gonna say, it's a good question though. At what point do you use something like QuickBooks and do this yourself and transition maybe to an outsourced, accounting or something more sophisticated? At what stage of the business do you usually see that happening?
Yeah, I mean, typically we see it after a Series A. So to put that in perspective, maybe a company has raised $5 million. They have 15 hires, and then they're at a point where it just gets too complicated to do with QuickBooks. But at the same time, I mean, I've worked at a private equity firm before, and we've seen businesses with $500 million in sales, and they're using QuickBooks. So it really just depends on how complicated your business is and what your comfort level is.
Got it. It's very interesting.
Yeah.
Okay, more questions? Don't be shy. This one's good. Do you see this? Where do you represent your cost to acquire a customer? How do you even estimate what it costs you to acquire a customer? And I'll add to that, what assumptions do you put in there? Because theoretically it should be maybe easier, or maybe it's more difficult the more volume you have on acquiring a customer. Where does all that fit?
Yeah, that's a great question. So where do you go to what cost of parts? So for this business, the cost to acquire a customer was really thinking about it as you bring on a salesperson and they will bring on a certain number of customers, and then you can kind of grow from there. It really depends on what industry you're in. So if you're an app, maybe you're going to need to have social media spend, right? And maybe if you spend $1,000 and you get 500 customers, then that would be a customer acquisition cost of $2. So it really just depends on how you're bringing customers on. So it could be making hires specifically for that. It could be advertising. It could be giving incentives or promotions, all of that. And it could be a combination of that. But what you really want to do is to be able to understand what are all the facets of that and how they come together. And then the key question is, you'll get to a customer acquisition cost. So say you're just using media, right? And you pay $2 to get a customer on your platform. Then the key question is, what is the lifetime value of that customer? And there's a few things that go into that. So how long is that customer going to be with you? And how much are they going to spend over that time? And that's called the lifetime value of the customer. And what you really want is, at the very minimum, it cannot cost more for you to acquire a customer than the lifetime value of the customer, or you're losing money. What you really want is to see like a 3 to 5 times lifetime value of the customer versus what you're paying for the customer. And to give you an example, to use that same social media example, maybe you're putting money into social media. It's for every $2 you spend, you get 1 customer. When you get a customer, they stay with you for 3 years on average, and they'll spend $1 every year. So your lifetime value of the customer would be $3. Your customer acquisition cost is $2. That's really, really tough. Like that would be, you're either going to need to figure out a way to pump up the lifetime value, which could be selling more per year to these customers, or having them be on the app for longer, or bring down the customer acquisition cost, which could be using different channels, using more word of mouth, which is obviously very cheap or free. So thinking about it that way. And the other example is if you spend $2 to get a customer, and they're with you for 3 years and they spend $5 a year, suddenly you're paying $2 to get $15 in revenue over the next 3 years. That is a great scenario.
And how does time factor into that equation, just in terms of, trying to sell through phone contacts, meetings, right? As opposed to just, I spent $1,000 in advertising, I got 100 customers, right? How does, from a startup perspective where, self-funding, and I'm just trying to get out there myself and talk to customers, how does that factor into this equation if an investor should ask?
Yeah, it's a good question. I mean, ultimately, it's typically pretty quick. So if it's social media spend, it should be a matter of days or weeks until you get these customers. If it's adding a salesperson, maybe it's, you're ramping the salesperson up for 3 months and then they're bringing on customers. But honestly, unless you're funding this yourself, it's typically not something that us as investors will be too concerned about, because it is a relatively short period of time. It's almost like an accounts receivable, right? So if I sell on Amazon, maybe it takes me 60 days to get paid. That's longer than it'll take to see a lot of these customers come to fruition. Does that make sense?
Yeah, that makes sense. Yeah, thanks.
Okay, another question, which I may ask Rick to actually ask directly, because I'm not sure. Understand insights about VC and equity partner or phantom stock split percentage, a good source to gain insight. I may ask Rick to jump in like verbally himself here, but comments?
What is the famous?
Sorry, go ahead, Rick.
Rick, can we get you on the mic directly?
Oh, sorry for the delay. I'm actually sitting at the dinner table with my laptop and I got grandkids. So if you hear any little ones, that's some of the fun. Actually, and I don't know if it's in the realm. This is a great, first of all, Alan, is great what you're putting out here. I've never gone down this road of starting a startup and a business and all these things. But my question is where, you know, you had mentioned like a VC as an example of depending on the investment, the VC's expected share might be between 3 to 10% as an example, or in the way of partners like business modeling when you get, if I get 3 partners, you know, how much should we allocate, you know, for both for the raise, if there's raising of funds and things of that sort, but then you also have, you know, maybe like phantom stock splits as a percentage or employees. In other words, do you consider 20%, just picking a number out of the year for employees long-term as you build your business that they get vested in?
Yep, great question. So I'll answer that in a couple parts. So the rule of thumb for venture capital fundraising is you typically will sell about 20 to 25, and I've seen less, I've seen more, 20 to 25% of your business each funding round. And what that means is if I am if I'm a $5 million business and I raise $1 million, everyone, all the current owners, so the founders, will be diluted by 20% for that funding round. And that will typically get you another 12 to 18 months, in which case you will do that again, raise at, you know, a $15 million valuation, maybe you raise $3 million and dilute everyone 20% until you get to a point where you're profitable and you don't need to continue raising. What I've seen in terms of option pool, and what I say by that is basically non-management equity incentive. I've seen anywhere from 10 to 20%. So what that means is you have, I mean, the way I think about it is you have your founders who start off with 100% of the business. As they raise, they continue to be diluted and the new investors come in and continue to be a larger and larger percentage of the company. And at the time of each raise, what's typically agreed upon with the investors is, hey, look, we're going to have 15% of the total equity reserved for our employees, our non-management employees. And then they can continue to give that out to new hires and let folks vest into that. But it's kind of reset every new raise to keep it at that 10 to 20% level.
What do you mean by reset at every new raise?
So just to give you an example, so maybe if I raised at a $5 million valuation and I had 20% of my company reserved for employees, if I raise again and everyone in the company, when I raise again, will be diluted. So if I sell 20% of my company the next round, the founders will be diluted 20%, and the current employees, that pool will also be diluted 20%. And basically what we agree upon as investors in the company is, hey, look, the founders can be diluted, but we really need 20% of the company. No matter what happens, we need 20% of the company to continue giving that to employees to incentivize them. So that pool never shrinks as a percentage amount.
You keep re-upping it.
Yeah.
I have a question based on that 20%.
Yep.
For the employees. I mean, you bring on employees and you want to incentivize them by, giving them equity in the company. But like, what do you do to make sure the employees doesn't just take the equity and walk? Like, how's that usually contractually structured? Like, they get vested over 5 years? What's the most typical way of doing that?
Yeah, so it's a vesting is the most traditional. So, I mean, I've seen anything from a year to 5 years is typically the maximum. And you can get creative in how you want to do it. But say, I mean, 2 years is kind of the threshold where maybe they vest 50% after 2 years or 50% after a year, and then slower after that. Or vice versa, if you're worried about them leaving, before 3 years, maybe that's the big cutoff where they're incentivized to stick around to at least that point. But the short answer is just vest over a period of time. And you can do kind of a standard vesting, like annual or monthly vesting is typically what I've seen. So if it's 36 month, 60 month vesting monthly is like something like that.
Good, we only have a couple of minutes left. I'll get to the questions in the chat. Our model will have assumptions, and one way to support our assumptions is to look at competitor data. Any recommendations for how we gain insights from business models, finances of our competitors, and or maybe even website resources to start this research into competitor models?
Yeah. So that's a tough one because I mean, coming from public markets, everything is public. Coming from private markets and venture capital, everything is private and you do not have access to it. So what I would say is there's actually a surprisingly good amount of information on if you just go to publicly available research, publicly available 10Qs, 10Ks, so annual and quarterly reports from public companies. So say you're a snack bar manufacturer, you can go to Cliff Bar's, filings and see, what their margins are, how they think about selling, what the risks they see are in their business, who their competitors are. And what's a really good resource is when these companies go public, they'll have what's called an S1, which is like a 200, 300 page document specifically showing the world exactly how they think about their business, the industry, all these things. So I think that's an awesome place to start. The reality is you're just not going to be able to get a ton of information on private businesses that are early stage, but you can use what you have access to, which is that publicly available info.
Excellent. Any final questions from anyone? I've got a couple of minutes left. Of course, there is one on the board there for your contact information. Entirely up to you. I can share it or not share it.
Don't share it. No, you can share it. And I just sent bamsec.com is the aggregation of all companies' public filings. But yeah, feel free to share my info, John. I'll connect with you on how to best share this model,
Okay,
and yeah, go from there.
perfect.
Yeah, I just had a comment on that last question. Person looking for information on private companies. One place you can look for information on private companies if they do have any government contracts. Even though their books are closed, you can see what the government's paying and what they're paying for it. So I've definitely done a lot of research on private companies through their government contracts.
I have a question.
Yes.
So like, when you're approaching investors, is there something, what's most important to like present to them? Like what would make them more inclined to invest in you from a financial standpoint? Even if you're like in the very beginner phase and don't have much to show for it, like what should you focus on?
Yeah, I mean, it's really, if you had to boil it down to one question, is this idea an idea that could become $1 billion business, or a very, very large business? Because the reality is a lot of startups will fail. So it's a numbers game. When you have a winner, the winners need to be really, really successful. So numbers don't lie. If you have good traction, if you're doing well, that speaks the loudest. But other than that, you want to show that there's a huge opportunity that you're going after. You're the right people to address this opportunity. You're uniquely positioned to address this opportunity, and that it's an attractive industry, really.
I was gonna say, as a seed investor, you don't necessarily have that much of a track record, but you want to make sure that the universe itself is large enough and that you can get a piece of it, correct?
Yep, that's exactly right. Yeah, I mean, we don't have a ton of financials to go off of, so we're looking at you know, what the potential is, and understanding, you know, is this business uniquely positioned to capture that potential versus what else is out there.
Excellent. Well, I'll tell you, there's, you know, it's past 6 o'clock, but nobody's playing to this room yet, and they certainly probably will very soon. But can we keep talking for another couple of minutes? Is that okay with you?
I got 2 minutes, and then I got to run.
Okay.
But yes, absolutely.
Okay, so we have a question on here. Can you see it? Market research.
And look at products with a wide price range. Yep. There's a gap. Interesting. Yeah, so I mean, there's a few different ways to interpret that question, but essentially, if anything that people are willing to pay 50 times the basic level for is I mean, it's I think I would add to that, you need to understand what's already in between there, right? So you have the very basic level, and then you have the highest premium. I think what you're getting, Andy, at is there's got to be some opportunity in the middle where you can have near premium quality for a much lower price. I think you just got to understand what's in between those two, right? So maybe there is an opportunity to do what the premium price product is doing at a lower price point, and that definitely makes sense. But just looking at those two ends of the spectrum, I think doesn't give you the full story. If there's 1,000 products in between, I would run away from that.
All right. Again, Alan, thank you. I will distribute, we'll figure out how to distribute the model and your contact info. This has been great. I think I can speak for everyone and say this was a very, very informative financial modeling session where people can actually take that template now and hopefully model their business. So thank you. I know you got to run. We could go on for another hour or two, but we can't right now. So again, thank you. Thank everyone for attending this session. And we'll look forward to seeing everyone next week.
Absolutely. Thank you so much, Sean. Thank you everyone for joining. Pleasure to meet you and looking forward to staying in touch.
Good. Bye-bye.
Cheers.